Can you see me? Can you hear me? Please let me know in the chat.
Hello.
Microphone.
Hello. Yes, we can see you.
Thank you. Thank you very much. Thank you. Okay. Nice to see you again. And today we will continue our lectures. And today I'm going to start with the short, brief presentation of our fourth model and the tasks of our fourth model in order you could have more information about our plans for the forthcoming model. And then we will start our lecture part, and today we will start a topic dedicated the question of evaluation of financial performance analysis, and evaluating the financial performance of our business. So let's start with a short, brief presentation of our fourth model and the tasks of the fourth model. Why I'm going to do it now, because our topic, our lecture topic today will be connected with our forthcoming model and the tasks of the fourth model. So I'd like to present you at first in order you could have the whole information about our plans. Okay, so let me open my course presentation, and it's our course presentation. You of course have it, but I'll add this course presentation and I'll add some new information. You can also follow me by using these files. These files you can find it in your folder files in MS Teams. And you can find it in the folder of files lecture number 8, because today we have lecture number 8. Okay, I hope you can see my presentation. And I'd like to show you some slides connected with the fourth model. So in the fourth model, we are going to study the following topics: fundamentals of managing the capital structure, debt policy, buyout policy, fundamentals of business relations, strategic corporate deals. Some of these topics, fundamentals of managing the capital structure, debt policy, and payout policy, are the part of our new topic, evaluating the company's performance. So today we will start our discussion connected with the financial performance analysis, and these topics, these questions, fundamentals of managing the capital structure, debt policy, payout policy, are the part of the new topic. And then the fundamentals of business evaluation and strategic corporate deals will be our next topics to discuss. Regarding the strategic corporate deals, it's about the mergers and acquisitions and how to evaluate these deals. Then the system of assessment are the same. so you can see my slide, and I think it's clear for you. And I'd like to show you the home task number 2. In the model 4, we will have the home task, and I'd like to tell you some words about this home task. So you have to form team, but in this team you will work with your classmates, but we'd like to form the teams of 2 or 3 persons, so smaller one than you had in the previous model, in the model number 3. Then you have to choose any open existing company. So you remember, of course, that in the model number 3 you worked with startup projects, but in next model we will work with real existing companies. And your task will be the following. Based on the financial reports for 3 years, 2018, 2019, 2020, you have to make the financial performance analysis of creditworthiness or bankruptcy risk analysis. And all these topics will be included in our themes of the model 4, so we will discuss it during our lectures and during our tutorials. And you have to use any available methods, approach, manuals for creditworthiness analysis. I write you that you may use manual or methodology of any bank or fund if you find it, so you can find it and you can use it in your work. And then you can use also any appropriate model for bankruptcy risk analysis. And again, during our lectures, we will discuss different types of models for bankruptcy risk analysis, and you can choose any models appropriate for you. And your task will be to make this financial performance analysis and to make the conclusion about the financial sustainability of the chosen company. The deadline, I'll inform you a little bit later because I have the schedule now. So regarding the certain date, we will inform you a little bit later. Now we know that results of your home task number 2 will be the following: in-class presentation in the teams and written analytical report. So you should present your results in class on the tutorial in the form of brief presentation, 5 or 7 minutes of duration, and answer the questions of your colleagues. And during this presentation, you will present the methodology and your results of your financial performance analysis and your conclusions about the financial performance of your company and the financial sustainability. The system of assessment of this home task will be the peer review, and final grade will be the average of grades from the other teams and the professor's grade for the presentation and written analytical report. Regarding the written analytical report, so we would like to recommend you to distribute all the works via all the persons, members of your team, in order each person has the certain responsibility for the certain, for example, for the certain chapter or for the certain part of your analytical report. So this are recommendations, and maybe later I'll add this presentation with these recommendations for you, and you can use these recommendations in your work in order to organize your teamwork. Then below you can find the possible source of information about the bankruptcy model. It is additional source for you. So you can find the article. This article is dedicated to the bankruptcy models, and based on these articles you can choose appropriate model for making the financial performance analysis if you will if you choose bankruptcy risk analysis for your work, for your analytical report. Any questions? Maybe now you have any questions. Of course, in the beginning of the model number 4, we will present you on tutorials again this presentation, and we will discuss it again. But maybe you'd like to start working with this task before we begin the model number 4, and before we begin the working during the tutorials. And that's why I decided to present you this home task in order you could start forming a team and choosing an existing company and thinking about this home task. If you have any questions, so please use the microphone or use the chat. I'm ready to answer your questions if you have ones. Okay. If you have no, I'd like to stop the demonstration in order to check the chat box. Okay, and I'd like to turn on the recording just in case. Okay, if you have no questions, I'd like to continue. I'd like to continue this brief presentation of our 4th model task, and some words about the business game. So key dates of the model number 4 home work presentation. It will be 3rd or 4th seminars. So the date for the presentation will be scheduled later, as I've mentioned before. And as for the business game, so as you know, the business game, it is a part of your accumulated grade. And the date of the business game, again, will be scheduled later. And approximately it will be 7th and or 8th seminars. It depends on the schedule of your tutorials. And I would like to present you the idea of the business game in order you could maybe start thinking about it, start forming a team. So the idea of the business game to present the report concern the business evaluation of the chosen company for the owners. So our possible roles will be strategic committee and owners. So strategic committee will present their business evaluation report about the business evaluation of the chosen companies, and owners will be make the decision about, will make the investment decision about these companies. So the idea is to present the results of the business evaluation of any existing company, and owners. And for owners, the task will be to prepare the criteria for investment alternatives evaluation, prepare questions for strategic committee, prepare brief conclusion, and to make the decision about this offer to invest or not to invest based on your criteria. So the peculiarity of this task, all the presentations and calculations should be sent 1 week before the business game. So we will discuss a little bit later how should you send these materials via LMS or maybe another way, but I think we will put it in LMS. And on the business game, the strategic committee, it is a team of from the company, and this team will present the result of business evaluation of the chosen company to the owners. So we will discuss in tutorials how many teams do we need, how many teams of strategic committees do we need, how many teams of owners do we need. I think that we will need several teams of strategic committee and maybe 1 or 2 teams of owners. And each part, each teams, strategic committee teams and owners teams will have the certain task. Any questions about this business game idea? If you have any questions, you may ask now or maybe later, because again, I'll repeat you again that we will discuss it on our tutorials, and when we start the model number 4, when we begin working in the model number 4, we will discuss it on tutorials. We will discuss this idea of the business game and home task. But if you like to start working with these tasks, of course you can start now before we begin the model number 4. Okay, if we have no questions, so let's move to our lecture part. And I'd like to remind you, I know that most of the teams will have the project presentations next week and on the last tutorial. And please, you may use samples of project presentation and calculations, and you can find the samples in the folder, files in the studying folder, and you can find it in the folder samples, and also you can find it in the folder lecture number 7. There is a folder called sample, and these samples are the presentation and the calculations. So please pay attention that you should bring with you on this project presentation the file with the presentation itself and the calculations. Calculations, I mean the calculations concern the projects. And you should calculate all the ratios, net present value, payback period, rate of return, internal rate of return, based on the financial functions in Microsoft Excel. Of course, you can calculate without using these financial functions, but maybe it's convenient for you to use these special financial functions integrated in Microsoft Excel. Okay. So let's move to our lecture part. So as I've mentioned before, today we start topic evaluating financial performance, and during these lectures and next lectures, we will work with this presentation. You will find this presentation in the folder in the MS Teams, so you can follow my screen, or you can follow your presentation. You can open it as you want, and we will discuss the following topics today. The following questions are concepts and principles of financial performance analysis, main uses, then group of users and financial result by areas of activities of these users. Then we will discuss the role of performance analysis. We will discuss the techniques and methods. Then we will move to the topic connected with corporate value creation and its measurement. And we will discuss the ratio analysis and its application. Of course, today, I think today our lecture will cover the part of these topics, the part of these questions. And let's start with the concept and principles of financial performance analysis. And on this slide, you can see the information about the main purposes of the financial performance analysis. The main concept, the main idea of the financial analysis is that financial analysis is a part of the business analysis. And the main idea of the financial performance analysis to accumulate, transform, then apply financial information for the several purposes. And the purposes, you can find it on this slide. And these are the following purposes: evaluation of the current and prospective financial position of an enterprise, evaluation of the possible and targeted speed of development, then clarifying the available sources of finance and assessment of the possibilities of mobilization and usefulness, and forecasting the status of an enterprise for different purposes. So we can forecast our financial status for different purposes. For example, for investing purposes, or for internal purposes. For example, when we are making the decision to about the financial resources, to attract financial resources from the bank, or to attract these financial resources to attract these financial resources from the investor. For these purposes, we need to forecast. And as a rule, when we are talking about the financial performance analysis, we have to take into account that there are a lot of users, can be a lot of users of our financial performance analysis, and these users or stakeholders have different interests. So, and that's why they have different objects of analysis. For example, on this table, you can find and you can see the different group of interests or different stakeholders that can be interested in financial performance analysis of our company. owners, investors, stockholders, enterprise management, employees, suppliers, customers, government. And all these stakeholders have own interests. For example, government is interested in tax payments, statistical data. So the object of analysis of the government is financial results. Then suppliers. The interest is to get payment for the goods delivered. So they are interested in analysis of enterprise solvency. Employees, so we are, for example, employees. We are interested in getting the salaries, social guarantees. So our interest is to get the information about the financial results and to get the information about the financial sustainability of our company. Enterprise management. Of course, it depends on the level of the management, but in general, enterprise management can be interested in benefits, some benefits. So they're interested in financial results, in performing and fulfillment the key performance indicators, to achieving the key performance indicators. Stockholders, they're interested in getting the return on capital investment. So they're interested in, again, the financial results, the borrowing capacity, for example. And owners, they're interested in getting the dividends. So financial results from operations are objects of the analysis. Also, we can analyze the different types of activities and financial results by areas of activity and groups of users. For example, if we are talking about the lenders, banks, and when they analyze the companies and potential clients, the potential clients, they are interested in getting the information about the liquidity of our business. They are interested in calculating the financial gearing of our business. They are interested in calculation, for example, if we are talking about the liquidity, banks always calculate the liquidity ratios, cash flow characteristics. If we are talking about the financial gearing, they will calculate the debt ratios, debt capitalization, gearing ratios. And of course, they are interested in debt servicing. And in this part of analysis, they are interested in getting the information about the interest cover, debt cover. So I'd like to tell you that as a structure of your report connected with the financial performance analysis always will be connected with this question: users, what types of users of your financial reports, and what is the main aim of your financial report. If you are a bank, so if you're a bank, you are, for example, financial analytics, and you're working for the bank, and your task is to evaluate the creditworthiness of your potential client. Of course, you will follow the instructions of your bank, the methodological instructions and the different approach that always use banks to evaluate the creditworthiness. And the part of this report will be the financial ratio analysis, and on our lectures, next lectures will be connected with this financial ratio analysis. The role of the performance analysis in the management framework. On this table, on this scheme, you can see that the performance analysis is the part of the management framework, and on different stage of making the decisions, we use the results of the performance analysis. For example, we use the performance analysis and the results of the performance analysis in planning and forecasting for controlling purposes. So we use it to analyze, to make the managerial decisions. So the performance analysis, financial performance analysis, play a very important role in the management framework. What are the techniques and methods that we use for financial performance analysis, for making the financial performance analysis? We use the following methods and techniques: vertical and horizontal analysis, financial ratio methods. So this financial ratio method is based on the calculation of special indicators, or so-called ratios. And we can classify these ratios by different groups: liquidity ratios, profitability ratios, solvency, asset use efficiency, investment ratios. The third technique is connected with trend analysis, then factor analysis, comparative analysis, and predicative models. We will discuss it during our lectures, and we will apply it on the tutorials in order you could understand how to apply it and how to use it in the correct way and how to get the interpretation. If we are talking about the techniques, existing techniques that we can use to compare the results, we use the following techniques. As you understand, when we are talking about the financial performance analysis, we use different, we analyze the information for different periods, for several periods, in order to compare the ratios, so in order to compare the financial results and other financial indicators of our company for different periods of times. And in order to get the interpretation, we use the comparison with the ideal level, comparison to previous periods, and comparison to the industry level. Comparison with the ideal level, or a normative, some normative level, or sometimes it's called rule of thumb measures. It's connected with the comparison with the normatives. But sometimes we have no normatives for certain financial indicators, and in these cases we can use the comparison to the previous level, to the previous periods. For example, we can calculate the liquidity ratios for the current year and for the past year, and to compare these periods. Comparison to the industry level. If we have this information about the average, industrial average, it's excellent, it's very good, because it's convenient to compare our current or calculated financial indicators to the industrial average. But sometimes we have no statistic data appropriate to use and to make this comparison. And in this case, we use the appropriate available data. For example, comparison to the previous periods are usually available for us. And when we are talking about the sources of the information that we use in our financial performance analysis, it's always the following sources of the information: financial statement data, economic data, market data, and information about the company, its important events, the audit reports, business evaluation reports, inside information, then external information from external sources, from the competitors, and so on. And let's talk about financial reports, because the financial statement data, it is a basic information for the financial performance analysis. So financial reports. What types of financial reports do you know? Please let me know using the chat, using the microphone. What types of financial reports do you know? And have you heard about the financial reports? In what course have you heard about the financial reports? And what do you remember about these financial reports? So I'd like to close for a while this demonstration in order to look at the chat box. Maybe you would like to tell me something about the financial reports. Balance sheet, of course, so it's one of the financial report. Maybe you remember something else. Balance sheet, okay. A statement of cash flows, okay. Changes in equity. So we have three main reports and other additional reports. So because the system of reporting includes a different financial reports. So three main: balance sheet, cash flow statement, and income statement. So these are three main reports. And other reports are additional. Sometimes it's obligatory for the company to make these reports. For example, joins to companies, open joins to companies are always have to make three main reports for accounting purposes: balance sheet, income statement, and statement of cash flows, cash flow statement, and other reports, other additional reports, for example, changes in equity and some other reports. But small business companies, middle business companies, as a rule, they use three main reports for accounting purposes, for tax purposes: a balance sheet, income statement, and statement of cash flows. And of course, it depends on the legislation, the regulation system of the country. And for example, in our country, in some cases, small business companies do not need to make all these statements: balance sheet and cash flow statements and income statement. They make they make reports, but in a simple way, more simple way, because of the legislation, because of some peculiarities of the legislation. Okay, so let's move to our presentation and continue our discussion about the financial reports. And thank you for your comments. Thank you that you are participating in our short discussion. So the main objectives of the financial statement. So you can find on this slide, you can see on this slide the objectives of the financial statements. So the main objective is to provide us with some information about the financial status of the enterprise, about the performance results, changes in the financial position. And then let's come back to the main financial reports. So I'd like to stop again the demonstration in order to discuss with you the objectives of these main reports. So we have discussed, we have mentioned before that in general, we have three main financial reports: balance sheet, income statement, or profit and loss account. So, but income statement, it's general accepted name of this report, and statement of cash flow, or cash flow statement. So please let's recall what is the main aim or main objective of balance sheet. What kind of information could we know from this balance sheet report? And the same question is about the statement of cash flows and the income statement. To present our inside results to other investors. So the general aim, yes, I agree with you, to present inside results or financial results to other investors. But what kind of information could we know from the balance sheet? Debts and assets. So we could know the information about the assets of our company and the main sources of these assets, because assets, it's our property, so-called property. We can use it in our production, in our operation activity to get the benefits. But the main sources of these assets is our debt or liabilities. It's more correctly to call it liabilities and equities. So these are main sources of our assets. Okay, thank you. And the main idea of the balance sheet is to find the information about the assets and liabilities and equities, and to understand the financial status of our company. Because if we make the financial analysis based on the balance sheet, we can calculate some ratios and to compare using the comparison of the balance sheet for the current period and the previous period, we can analyze and understand financial status of our company, the changes in financial status of our company. Okay, let's talk about the income statement. What type of information could we know from this income statement, and what is the main objective of income statement? What do you remember? All about the net income. So the main objective of the income statement is to give us the information about the efficiency of our company, efficiency of our business, because we are getting the information about the net income and we can calculate the different types of the indicators concern the efficiency. Okay. Then statement of cash flows, cash flow statement. Cash flow statement. What does it mean, cash flow statement? What information could we know about from this statement? For what purposes we use this cash flow statement? So we are talking about not about the forecasting cash flow statement. So for your project presentation, you are preparing the forecasting cash flow statement. But now we are talking about the cash flow statement for a certain period of time. Where are they from? From what operations? Okay, so usually we use we can use different formats of cash flow statements, and according to the international financial standards, the content of our reports is more important than the form of our reports. So that's why we can use different approach. We can use different approach to present this information stated in cash flow statement. And sometimes we can use the structure of cash flow statement that will help us to understand from what operations we are getting these cash flows. What does it mean? We have different types of operations, and what types of operations our business has. So, what types of operations do you know?
No, financial.
Financial. So what do you mean? Financial? Yes, investing, financial, and so-called operational activity. This is our main activity of our business. We are getting the general cash flows from this operational activity, or cash flows, or we can call it cash flow from operational activity, cash flow from financial activity, cash flow from investment activity. Okay, and sometimes we can see the cash flow statement structured based on these types of activities: investing, financing, and operational activities. Okay, thank you for your comments. Let's move to the presentation. And when we are talking about the financial reports, of course, we should recall about the basic principles of reporting, and these are the international financial standard principles. These principles are general, and these principles are used in Russian Federation, in other countries, because they are general, generally accepted principles. Accruals principles, going concern principles. So these are two main principles that we use in our financial reporting. Accruals principle, it means that transactions and events are recognized at the moment of occurring, not at the moment of when cash or equivalents are received or paid. So it's very important accrual principle Especially, it's very important to understand this accrual principle when we are talking about the difference between the income statement and cash flow statement. So when we are talking about the income statement, so the main cause of this difference between the income statement and the income as an indicator and the cash flow and the ending cash flow is this accrual principle. So this accrual principle explains us the difference between the income statement and the cash flow statement. The main difference is that any transactions or other events are recognized at the moment of occurring in the income statement, not at the moment when cash or equivalents are received or paid. And the going concern principle. Going concern principle, the main idea of this principle that financial statements are made by assuming that the enterprise is going concern and will continue to exist and will continue its business in the foreseeable future. And based on the international financial standards, the information used in our financial reporting should meet the following requirements: understandability, relevance, reliability, comparability, and timeliness. And it means that we use different periods for reporting, and we should use the appropriate information, the relevant for this time period. Comparability, it means that if we use, if we have to compare the different periods of times, we have to compare the relevant periods. For example, if we have a balance sheet for 9 months, so we have to compare this current period with the previous period. The previous period should be 9 months too. So if we are talking about the balance sheet for a year period, so we have to use the balance sheet for the previous year again, also for year, for the whole year. And understandability, it means that we should use the concrete information, and we should understand that this information is clear for us as for user, and this information should be clear for other stakeholders of this information and these analytical reports. And relevance, reliability, relevance, that it means that we should use correctly the accrual principle. And reliability, it means that we should use the documents, and we should write all the, we should take into account all the operations based on the correct documentation, so proper documentation. And let's look at this slide. It's about the balance sheet, and let's recall something from the balance sheet again. So we have mentioned before that our balance sheet is structured in the following way. So the first part it's about the assets, and the second part it's about the liabilities and equity. And the logic is the following. So assets show amounts and the types of resources that we use in our business, and the sources or the enterprise resources presented as assets are disclosed under the liabilities. So liabilities are sources of our assets. And let's look at this balance sheet and let's recall a little bit about the structure of assets and the structure of liabilities. We use the term current assets, fixed assets, long-term assets, liabilities is structured in the following way: current liabilities, long-term debt. And please give me examples of the current assets. And what do you know about the current assets? What are the main characteristics of the current or short-term assets? So short-term, current assets are synonyms. So please let me know about what do you understand, what does it mean? Current assets or short assets, what are the main characteristics of these types of assets? And please give me examples. I'd like to close the demonstration in order to, you may use a microphone if you want, in order not to close, maybe. Okay, I've stopped the demonstration in order to look at your chat box. So let me know about current and short-term assets. What do you know about the current and short-term assets? So these are synonyms. And please give me examples of current and short-term assets. So if maybe you don't remember well the difference between the current or long-term assets, and of course I'll help you. So current or short-term assets are assets that are used, consumed or sold within one reporting period. Or sometimes we can say that current assets are assets whose value is transferred to goods for sale within one operating cycle. Assets that can be converted, used to cash within 12 months, example inventories. Okay, you are close to the logic, but your definition is more close to the definition of liquidity and liquid assets. So sometimes, of course, current and short-term assets means that they are more liquid. Of course, they are more liquid than long-term assets. But the main characteristic of these current or short-term assets that these assets are used for within one reporting cycle, one reporting period, and the value of these assets is transferred to goods for sale within one operating cycle. And of course, another characteristic of these current or short-term assets that they are more liquid than long-term assets, so they can be converted into cash rapidly. It depends on the type of current or short-term assets. But if we are talking about the current assets or long-term assets, of course, current assets can be transferred to cash more rapidly, of course. Okay, and regarding the examples, so examples of the current assets are cash, short-term financial investments, account receivables, inventories. Let's come back to to the presentation. So the balance sheet is the main logic of the balance sheet is this equation: assets equals to liabilities plus shareholders' equity. And it's very important to understand the difference between the current and long-term assets and current and long-term liabilities. So the logic is the same as we use in assets. And shareholders' equities, the logic is the following: that it represents owners' claims against existing assets. So in other words, that money has already been spent. And this table shows you the composition of current assets by the degree of risk of capital investment. What does it mean? So when we are talking about the structure of the balance sheet and the prioritization of assets and liabilities, based on the principles of international financial standards, it doesn't matter if we begin with the current assets or if we begin with the long-term assets. So it doesn't matter. So because the form is not important, the content is important. But if we are talking about the Russian Federation, we have more strict rules for the balance sheet and the reporting, financial reporting. And in our balance sheet, we will see, at first, we will see the long-term assets and then current assets. And the same situation with the liabilities and equity. At first, we will see the equity and then liabilities. And liabilities is structured in the following way. At first, we will see the long-term debt and then current liabilities. But for analysis purposes and for the financial, for making the financial performance analysis, for these purposes, it doesn't matter the prioritization of the assets and liabilities. But you should understand this prioritization, for example, by different criteria, we can classify the assets and liabilities. And by risk, if we are talking about the risk and liquidity, so these are main criteria for prioritization, the assets and liabilities. And if we are talking about the degree of risk of capital investment, we can classify current assets in this way. So current assets with a minimum degree of risk, cash and short-term financial investments. So they are more liquid. So in this table, I would use degree of risk and degree of liquid. So why degree of risk? Because current assets with a minimum degree of risk, it means that these current assets have maximum liquidity, maximum degree of liquidity. Current assets with a low degree of risk, account receivables, but it depends on the liquidity of these accounts receivable. Production reserves, stocks of goods for sale. Of course, it again depends on the liquidity. So we should analyze the degree of liquidity in order to define the degree of risk. Third one, current assets with a medium degree of risk, low value inventory, work in progress, prepared expenses. And fourth one, current assets with a high degree of risk, doubtful doubtful debtors and obsolete production reserves, goods for sale, for which there is no demand. So we are talking about the non-liquid goods for sale. And let's talk about the income statement. So the main logic of the income statement to give us the information about the efficiency and the net income. So this is the structure of income statement. So we can see that we finally we are interested in net income and different types of incomes. To measure the earnings, to measure the income, we have to use the accrual principle. And according to this accrual principle, we have to identify revenues for the period and matching the corresponding cost to the revenue. So it is how to apply its accrual principle, accrual accounting, when we are talking about the income statement. To measure of earnings, we have to follow these steps: identify revenues for the period and match the corresponding cost for the revenues. And doing in this way, we will get the income statement, and based on this income statement, we will get the net income. And let's talk about the cash flow. Yes, you were right when you mentioned about the different types of cash flows from operating activity, from financing activity, and from investment activity. This is important when we are talking about the cash flow cycle. To identify these different types of activities. And when we are talking about the cash flow cycle, it's very important to identify also operating cycle and investment activity, because it's important when we are talking about the difference between the income statement and cash flow statement. So this is the cash flow cycle. What can we see on this slide, on this scheme? At first, when we are talking about the business, we have to we have to raise money from owners and creditors, and we have to purchase productive assets to start our operations. To start operations, company uses cash, and company uses cash to buy raw materials and hire workers. Then company makes the product and stores it temporarily in inventory. And when we are talking about the inventory, our cash is physical inventory. And then when the company sells the goods, inventory changed back into cash. Or in the beginning into the account receivable and then into cash. So on this scheme, we can see different types of different forms of cash. So cash in different forms. Cash in the form of cash, then cash in the form of account receivables, then in inventories, then in fixed assets, and then in cash. This is the cash flow cycle, and it's for us it will be important, and again we will come back to this cash flow cycle when we will talk about the different financial ratios that can characterize the activities of our company in terms of different ratios. For example, or ratios that can characterize the account receivable to nowhere, then payables to nowhere, and so on. Fixed asset to nowhere, inventory to nowhere. And when we will talk about these ratios, we will come back to cash flow cycle and we will discuss it again. Of course, for understanding the difference between the cash flow and the income statement, we should recall the investment and depreciation. So when we are talking about the income statement, we can see only depreciation and we can't see investment, because investment and the amount of investment that we for example invested and we purchased in this period of time, we could also see in our cash flow statement, but not in income statement. And income statement we can see only depreciation based on this investment. So and the explanation, what does it mean, investment and depreciation in terms of the reporting. Over a period of time, the company's fixed assets are consumed or worn out in the creation of products, and every item passing through the business takes with it a small portion of the value of fixed assets. And we know this process as depreciation. So the process by continually reducing the accounting value of fixed assets and increasing the value of merchandise flowing into inventory by amount, it is depreciation. And to maintain the productive capacity, company must invest part of its newly received cash in new fixed assets. But if we are talking about the reporting system, depreciation will be mentioned only in income statement as a part of the cost of goods sold. And investment as a whole amount of investment, we can see it only in cash flow statement, in investment activity, in the cash flow from investing activity. So profits do not equal cash flow. It's important to understand, and it's important to understand that company can be profitable, but in the same time can feel deficit of cash. So could you explain this? The company can be profitable, but in the same time can feel deficit of cash. Could you give me some example of this situation? Could you explain what does it mean? What does it mean and why? You can use microphone, you can use chat box, and I have closed the demonstration in order to see your chat box with your ideas. What does it mean? Company is profitable but feels the deficit of cash. So it means that company has a problem with liquidity. Sometimes we can see this situation when we are talking about the liquidity ratios. And sometimes we can see that company has a very good liquidity ratios, and the liquid assets, for example, current assets, are increasing for some period of times, but at the same time, company feels the deficit of cash. In this situation, we should analyze the liquidity of assets, because from the one hand, it's a good situation when the liquid assets, current assets, are increasing from period to period. But in some cases, it's not good. It's negative. It can have the negative effect when we are talking about the increasing in, for example, in problem account receivables. We can face with this situation when the account receivables are increasing from the period to period, but it's connected with the fact that our partners, our buyers wouldn't like to pay bills. So it's a problem for us. It's a problem for our company, and we should solve this problem as soon as possible, because from one hand, it's a good situation when we have a big increase in liquidity ratios. But if this situation is not changing, and the account receivables and our liquidity ratios is increasing because of the increasing in account receivables, it's a problem situation for us. So it's not a good situation for us. And the same situation we will have when the liquidity ratios are increasing, for example, because of the increase in inventories or increase in stocks. And the main cause of this increase can be connected with the negative demand, low quality of our goods and services. So it can have the negative effect. So it will, this situation will have the negative effect, and this negative effect is connected with the problem in marketing, the problem in logistics, the problem in the total quality management, and so on. So that's why we can face the situation when, from one hand, our business is profitable on the paper, based on the reports, but from the other hand, on the other hand, we have some problems with in our management framework. Okay, so let's make a break, and after the break we will continue working with this topic, financial performance analysis, and we will talk about the value creation, the corporate value creation, and other topics. So thank you for being here, for participation, and let's have a break.